Hi, let me comment something about this because people also come into my inbox asking me about the same. By the way, I'm not a financial advisor. Visit your financial advisor, they'll advise you whether to buy the offer or not. I'm just talking out of experience. So if you look at this IPO, if you go through their information memorandum, they have issued 18.2 billion shares. And out of these 18.2 billion, 65% that is what is offered to the market for people to buy. So 18.2 billion shares, that is quite huge. So that one will translate to the valuation of the company to 164 billion because it's 18.2 billion shares issued times the offer price of 9 translates to the company being valued at 164 billion. The amount of shares issued is quite huge because what Kenya Pipeline did, they split one Kenya Pipeline share to 1,000 shares, quite huge. So what does this one mean to a retail investor like you and me? When it comes to future dividends, it will make the dividend yields to be kidogo, because what it means, the amount of dividend yenye you are being paid as an investor, it's little because the amount of shares which are in the market, they are quite huge. If I put it in another language so that people can understand, assume a company is making 20,000 in terms of profit and is sharing that profit to 5 people. So 5 people divided by 20 each get around 4,000. But assume the number of people goes up to 10. So each person now will get 2,000 instead of the 4,000. So that's what it means for dividend yield. So if the shares issued in the market are quite huge, dividend yields go down. And you can see some companies like BAT, because the total issued shares, it's not a lot. That's why it can afford to pay dividends of even 50 bob per share. Yes, so that is something to consider, the future dividend yields. Currently, the dividend yield is at 4% because their dividend, the earning per share is 0.412 after the split. And if you compare that with the price, so their dividend yield is 4% at the moment. What if that price go down? That dividend yield might also go down. That is something to compare, to consider. You also have to consider the price earning ratio. The price earning ratio, for those ones who don't understand, it's how long it will take for you to recoup the money that you invested. Like now, we are investing 9 bob per share and the earning per share is 0.41. So it will take you 21.83 years for you to get back your money. And if I put it in another language that people can understand, if you go to the market and buy nyanyas for 20 bob and you want to sell to make money, so assume every day you are selling nyanyas for 5 bob. You bought them at 20 bob, every day you are selling at 5 bob. So for you to recoup your 20 bob, it will be 5 bob today, 5 bob tomorrow, 5 bob. It will take you how many days? It will take you 4 days to recoup your 20 bob. The same thing with price earning ratio. The same thing. It will take us 21.83 years to recoup your 9 bob. So which is a bit high if you compare to the other companies in the energy sector like Kenya Power and Kengen. Kengen, I think it's around 6 years. Kenya Power, I think it's approximately above 1 year. So if you compare that, if you consider that the price earning ratio, it is taking you a lot of years for you to recoup the money that you invested in it. Then the other thing you need to consider, also consider the Kenya Pipeline as a company. At the moment, it's enjoying, what do I call it? It's enjoying more of a monopoly because we don't have a company which has that kind of infrastructure to distribute the fuel. So what that means, their earning capacity is predictable, or the service that they are offering, it's relatively iko demand. It's kind of a monopoly. It's already being demanded. So that is something. So it has the capacity. Because of that, it has the capacity for sustainable earning in the future, and also paying dividends. If you look at also their financials, they have paid dividends. I think it's only 1 year. Was it year 2022 that they didn't pay the dividends? I need to go back to the financials and check. So they have paid dividends. So you can look at that, their earning capacity, and also the demand for. Though also not forgetting the electrical cars and the bikes, they are coming up. That is a competition in the future. We don't know whether that will be the in thing then, and then we don't need the fuel. Although at the moment it's not a risk, because electric vehicles adoption, it is gradual, and then because of its low, it's high upfront costs and limited charging infrastructure, so it's not a risk at the moment. So KPC core business is still remain resilient, and is being supported by growing energy demand and population growth. People are buying cars left, right, and center. And also its role as a regional fuel transit hub. Though there is that also threat where Uganda had proposed to come up with their refinery. So that is also a threat that you need to consider. So take your time, go through the information memorandum, go through the financial statement, make a decision independently, make a decision whether you are buying the offer or not. Avoid the market noise. In conclusion, thank you for all those people who have bought my ebook. Much appreciation, and thank you for your support. For those others who are still yet to buy, the link is quite safe. Some people are writing and saying that they are not sure. No, the link is quite safe. You just follow the prompt and pay for the ebook. It will guide you on how to become a smart investor, especially for beginners. It has outlined how you can open a CDS account, how to select the best shares to start with, how the best brokers plus their respective fees, all that, and also how to balance your portfolio. So grab one today for an introductory price of 400, and I can assure you it's value for your money. Thank you.